Good morning. My name is Don Vivrette. Welcome to Financial and Estate Literacy. This is It's Your Money, spring of 2022. This is week 5, equity and fixed income investing. And I'm going to do a little bit of housekeeping here at the beginning of this. So let me bring up one thing here and go click. There is a workbook which has been developed to go along with the course. The course was redone. We're now 6 weeks instead of 8 weeks. And so there is material in the on the website, which I will show you in just a moment, in terms of what is available and how you can go through it. The workbook was done for you, for the participants. It's a document to talk about, here's where this whole thing goes, but it's really a planning tool, looking at where you are today, what are your goals, what are your priorities, and what are you doing? So before you begin a conversation, perhaps with a financial advisor, you go through this kind of process. Pete, what's financial and estate literacy?
Financial and estate literacy, we're talking about educating you about money. The United States is one of the more illiterate states or countries that people do not know much about money. And so money is important, makes the world go around, and we're a not-for-profit, and we do not allow any for-profit to be a sponsor, and we don't allow any presenter to be a commissioned salesperson. So nothing is sold. Nobody gets your names, and none of the presenters get your names and contact information. We try to do pure education. By the way, you, the attendees, is what we're all about. We need to hear from you and let us know how we can improve. What don't you like? What do you like? We welcome your feedback because that's the only way we can make it better. So
let's walk through the material here. So if you come into the website, and incidentally, there's now a short version of this. It's
IYME.org.
Which is a lot less than this whole title up here at the top of the screen. Yeah. We got the initials going this time. If you click on workshops, we did this the other day, and of course it decided not to work. We're in It's Your Money, so I'm going to click on that one. And I'm going to click down here on equity and fixed income investing, which is today. So here's the material that we have for today, the outline for the presentation that Mark's going to do, as well as his Ask First form, which we won't officially look at here, but is available for you for contact information, and a series of articles, which Pete goes through religiously each time and puts in new articles and refreshes old ones or does something else. Just as a note, incidentally, I'll back up to last week. So the presentation for last week is already here, which is very normal. It will probably be here for a good 6 months or so afterwards. If you wanted estate, you could click on the estate sessions and go look at those. The material is here. The videos are here. Please use them. And Pete just made a really good point. We've now changed the this session, these series, went from 8 weeks to 6 weeks. If you have any comments in terms of that's good or bad, please feel free to let us know. It was a project we went through. It's program's been going for 20 plus years, and we decided it was time for a refresher, and that's what we did. You may say that was good, that's nice, or bad, that's a learning experience for us, and that's where we are. So Pete, okay. I'm going to let you go on and ask Mark to come up, and I'm going to disappear, and I will ask questions. Again, please use Q&A, and I will monitor those.
Okay, bye, guys. Thank you, Don. Good morning, Mark.
Good morning. How are you?
Okay, doing really well. Thanks for coming on. Really appreciate it. We're going to talk about equities and fixed income. But before we do, your Ask First form is online, so we're not going to bring it up, but let's go briefly for an introduction. Education level is you have?
Yeah, a bachelor's degree from UC Irvine. I was a computer science major, like every other financial advisor. So definitely an unusual path to get here.
How long have you been in the business of financial planning?
Over 20. This is my 25th year as an advisor.
Okay, you're an APA, and I don't understand what that exactly means. And you are a CFP. What is an APA?
Yeah, APA came from my former life, an accredited pension administrator. So it's a pretty unique background. I used to work in the retirement planning, 401k, profit sharing pension world.
Okay. Let's go. You're a fiduciary. I think everybody understands what a fiduciary means. You're fee only. So how do you charge your clients?
Yeah, so I work with clients in any of three ways, and I'm currently I've reached capacity, so I'm not adding new clients actively at this point. But the three ways are a little unusual, so it takes a little bit of time. I work with clients on a project basis where they just can come in, sit down for 2 hours, or and I was formerly offering full, one-time financial plans for good disciplined do-it-yourselfers could have a full review of their situation. The second way is for people that aren't rich yet, and they can just pay for the services a la carte. So a young couple that's starting a family but makes a lot of money, needs planning, needs someone to keep them accountable, and they would just pay me with a credit card every single month. I have several clients that do that. And then the traditional way that fee-only advisors work is the assets under management version, where you are managing your money, often offering financial planning at the same time and charging some percentage of assets.
If I give you $500,000 to invest in my money, what would you charge?
Yeah, so my billing starts at 0.8%. So it's always dangerous for me to do math in my head, but
Okay.
that's $4,000 a year if I'm doing the math right.
Okay. And does a financial plan become part of that assets under management fee?
Yeah. So I do planning. I do ongoing planning. So we don't do I don't do a pay by the pound type plan where we just do a one-time plan and say, it's good. We're doing planning. So we're revisiting all of these areas: retirement, if it's of course your investments, your estate planning, your insurance issues, all of that. It's ongoing planning throughout the year.
So right now you're not accepting any new clients, but you've been in the business for 25 years. If somebody calls you and says, hey, I need some advice, can you refer them out to one of your other professionals that you are familiar with?
100%. So I take time. The most important thing I can do at this point is if there's questions that I can answer in a short period of time, if they're just the basic financial literacy type questions, many times I can just take 30 minutes and take that time. I do a lot of pro bono work, but if they're not a good fit for me, and I have a long list of people that I would send my parents to, in essence, and they're of course fee-only advisors. Many of them have spoke on this in this very session right now.
Yeah, and there's no charge for this, I'm assuming.
No, I'm happy to. I want people to get away from the sharks. That's if that's all I can do, that's a put that on my tombstone. Got people away from the sharks. That's good enough.
Yeah. And what we mean by sharks is the sales. Okay. Managing your money is not about selling stuff. And we got to get that through people's heads somehow. So your Ask First form is on our website. So if they want more information, that they can go there. And you also have a website, I assume?
Yeah, Mile Wealth.
Mile, M-I-L-E.
Yes, Mile stands for making it look easy, which is a little cocky. And Mile Wealth, M-I-L-E wealth.com. Okay,
we got a lot of material to go through. And so let's get started.
Yeah, so we're here today to cover this brand new session, stocks. This was formerly equities or stocks and fixed income or bonds. They were broken out to two independent sessions. So if it feels like we're working through this quickly, we are working through this quickly. At the end of the day, I really want to cover the basics of these different types of investments, asset classes, I'll call them. We want to talk about just kind of the top 2 or 3 things I would like people to know about, specifically bonds and specifically stocks. And then if we get to it, we'll talk about how to put it all together, which is one of the most important. And of course, wish us luck as we go through this. These asset classes are very different over time. Cash, we will not spend much time here. People know what cash, it's basically money. It's protected, it's safe. When you need it on Thursday, you don't worry about whether it's worth more or worth less. And it's liquid, typically very accessible. People are used to these, these we all live with our checking and savings accounts. You might also have a money market account. I would also lump into the cash category things that are very safe and secure, such as short-term CDs and T-bills. T-bills are the shortest term United States bond investments, typically under 1 year or less.
And it's considered the safest money in the world, safest investment.
Absolutely. Short-term government bonds, when the US can print money, they're not going to default on their debt. And when it's only a very short term, you're not worried about interest rate movements changing the value of the bond itself.
And why is that important for people to know? Especially, we just had an announcement that there's going to be a 50 basis points increase.
Yeah, well, actually, yesterday was a 50 basis points increase. So we're expecting a lot more. It's important. Cash is important because cash does not go up and down with interest rates. The value is the value. And so you don't need to worry about what the Fed chairman is doing as far as raising interest rates. In fact, it's helpful. As interest rates go up, typically your cash, your savings rate, your maybe what you're earning on your checking account, certainly on a high yield savings accounts, they're now reaching 1% and more, where a year and a half ago earning more than 0.5% was very difficult. So the point, the really important part is this is there for you. If you need it, it's there for you.
Okay, let's go to the next slide.
Yeah, this jumping back and forth, I'll have to get used to it. The benefits are, we've just talked through it, really safety, liquidity, and that you're earning a higher yield than just keeping it under your mattress, but barely more than keeping it under your mattress. Over long periods of time, this is averaged inflation. That is not the case today, as we've seen inflation in the 7-8% range, yet interest rates are in the very low rate. But historically, that's been the case. And crazy as it may seem, long-term returns on cash has averaged 3 to 4%. That's hard for us to imagine given where we are today. Switching over to fixed income, and when I use the term fixed income, think about bonds, and I will use these interchangeably ultimately. So excuse me as I jump back and forth between them, but these are loans in all the different formats, an IOU in essence. You're giving money to someone, they're going to give it back to you, hopefully, and give you more than you started with, maybe with some interest along the way. And the examples of this are longer term CDs. Most of us pretty much understand these. US Treasuries, where you're loaning the money to the US government for treasuries, treasury bonds and treasury notes are longer term than the T-bills. They might be up to 5 years and up to 30 years for US Treasury or notes. Municipal bonds, you're loaning the money to a municipality. You might be loaning it to a school, you might be loaning to a toll road, you might be loaning it to a water district. Corporate bonds are loans to corporations, loaning it to Apple or IBM. Mortgage-backed securities, loaning money to that people are buying mortgages. There's real estate behind the scenes, and there's even international frontier market, junk bonds, many other things that are out there.
Is the bond market bigger than the equity market?
Yeah, it's a great question. So the bond markets themselves are enormously bigger than the stock market. So the public stock markets have in the range of 4,000 to 5,000 individual tickers. In the bond market, in terms of total size, is substantially bigger than that. But in terms of number of actual individual bonds, there are hundreds of thousands of individual bonds. So one company might loan out, have multiple loans against them. IBM could have 10 or 100 different loans that are outstanding.
So from a consumer point of view, if they're wanting to buy a bond, it seems like it would be simpler, but it sounds like it might be even more difficult than the equity market.
100% more difficult. A lot of it has to do with the way that when you want to go buy a stock, there's only one stock. There's not multiple classes. There's not multiple versions of the Apple stock if you want to go buy a share. If you wanted to have a loan from Apple, there could be hundreds of different options available. And the second thing is when you're buying just the one from Apple, there's a very fair mechanism. The stock market is giving you a very fair mechanism to buy and sell these. But in the bond market, things are gone through in auctions, and you don't know. It's not transparent at all, and people that don't know what they're doing can really lose a lot of benefit of buying an individual bond. So I definitely dissuade people from doing that.
Okay, let's go to the next slide.
The benefits of fixed income is all about dependable income, and most of the cases you're receiving periodic payments. Most bonds pay semi-annual or twice-a-year payments, but some will pay monthly, some will pay annually, and some will pay you nothing and just your principal when you get it back. So a zero coupon bond, meaning is they don't pay any interest along the way. You will buy the bond for, let's say, $90, and at the end of the 20 years or 10 years or whatever, you'll get your $100 back, but they don't pay you any yield or coupon along the way. Bonds are typically paying higher yields, higher interest than cash, and higher than inflation. They've averaged 2.5% to 3% above the inflation rate. Again, we're not in that category today. And long-term returns, again, this is hard to imagine in the interest rate world that we're in today, but have averaged 5.5% to 6%. Today, bond returns, the US 10-year Treasury is paying just 3%. Where at the beginning of a year and a half ago, we were looking at really close to 2% at that point. So we've seen a major difference there, but you're not going to earn this 5.5% to 6% in traditional bonds without taking some risk.
But why is that important to know? Why is it important to know that 5 to 6% is the normal for long-term bonds?
Yeah, so I think it's important to know that it's higher only because people might try to sell you something thinking you're going to end up with those higher rates, and really then they might be giving you historical information, but that's not what we're expecting today. Where are you?
But wouldn't it be also that as we see interest rates rising today, traditionally, it's still lower than historically that it has been. In other words, it seems like we don't need to panic.
Yeah, so we want rates to go higher. So it's a painful, and we'll talk about the impact of interest rates going up and bonds going down. But people want. Would you rather have your checking account paying you 3% or 0%? Of course, we want it paying us 3%. Would I rather own a bond that's paying me 6% or 3%? Yeah. Of course, I'd rather own the 6%. But the pain is when things go up again. That is where, and we'll see that dynamic in another slide, but it's an issue there.
Yeah. On the last slide, if you want to bring it up, you read at the bottom of it, you talk about complement to other investments. Talk a little bit about that, because this, from my point of view, this is the purpose of bonds in your portfolio.
Exactly, 100%. So bonds are boring, safe, but they're there when you need them. You're there when you need them. And we'll talk about today, what's going on today, because it's definitely an unusual period. But traditionally, these are there to be the ballast to the portfolio. They're there for your shorter term needs. And they often, 90-some% of the time, act differently than stocks. So when the stock market goes down, bonds are up. In 2008, we had a global financial meltdown. Stocks were down close to 50% at that point. Bonds were up 5% that year. You're very happy to own that portion in there. And if you needed money that year, guess what? You pulled it from your bonds. You didn't want to pull it from your stocks.
That's what's happening right now. As the stock market has gone down, the bond market has gone up.
So actually the opposite. So we're actually seeing right now, interest rates have been going up.
Oh, I meant the interest rate. Sorry.
Yeah. So interest rates are going up, but bond prices are actually getting hit really hard right now. And it's an unusual time where we're not seeing that complementary. And what's actually happening is we're actually seeing the stock market is going down because interest rates are going up, which means bond prices are going down. So bonds getting beat up is actually, in my opinion, causing stock prices to go down as well.
Are we going to talk about bond funds versus individual bonds a little later?
I did not have time to fit that in.
That's okay. That's okay.
Cover that.
Would you recommend people buy individual bonds or bond funds today?
Yeah, I'm a big fan of people buying bond funds rather than individual bonds, mostly because of the liquidity and the transparency that you're able to get. If someone's selling you a bond, you don't know what you're paying, you don't know if it's a fair price, and probably it's not when you're buying it.
How about bond funds in an index?
Yeah, so I'm a fan of, I love index funds for equities. I'm not a fan of them on the fixed income
bond side.
But I'd rather have, I think there are, you would pay a professional to manage the bonds, pay the lowest cost you can possibly pay for that professional. But there are many bond firms that don't have to have the same concentration of government bonds, long-term bonds, short-term bonds. So I think they can beat the bond market over some period of time.
If you were to go to recommend any kind of a mutual fund, would you recommend Vanguard for bond funds?
Yeah, for bond funds, prices are the #1 determinant of what the value that you're going to get. I would look towards Vanguard. I would look towards the PIMCO. I would look towards Metropolitan West. Those are kind of the three ones that I would look towards.
Okay, let's go back to your outline.
You need like one of those little clickers. Like
I know. I'm making you work.
Yeah. So moving on to equities, people think of, and again, equities, we're talking about the stocks here. These are not, people think of equities as being gambling. It's not horses. We're not talking about roulette wheels, and we're not talking about EKG where it goes up, it must come down again, it must go up again, and sometimes it flatlines. That is not what stocks are. They are a piece of a business. And I think the biggest part that people miss is they look at a chart to determine whether they want to buy a stock. They look at the price and what if it's got a green thing pointing up or a red thing pointing down to decide. But stock market investing is about thinking about you're actually getting piece of a business, or when you're buying index funds, you're getting a piece of many, many businesses, and you're betting on the US innovation and US economy doing well over lengths of time. And no one wants to bet against the US and us being innovative and doing well over time.
So you would discourage people to trade stocks?
Yeah, so absolutely. So I think, and we have a slide about this and why I would, and so maybe we can defer that till later. Yeah.
Okay.
I lost you here. Hold on one second, Pete. Wrong button.
Would you recommend Fidelity bond funds?
Yeah, Fidelity has some good low-cost bond funds. I wouldn't hesitate to use Fidelity.
But low cost is the key.
100%. It's very difficult for anyone to outperform, especially if they have high fees.
Yeah.
So stocks are broken out into different categories. And so when you own a stock, they should be thought about that. What kind of different categories are you buying? And this terminology that's out there is this called cap, large cap, small cap, so forth. Capitalization is the size of the company. If you were to buy the entire company, is it cost you more than 10 billion to buy the company, like Tesla, Johnson & Johnson, and Amazon? Or is it under 2 billion, like Avis, Tennant, or Macy's? You can see the difference between a Macy's in terms of company size and Amazon in terms of company size. And Johnson & Johnson, huge company compared to a healthcare company, for example.
Mark, why is it important to know this?
Yes, so, and I love that you're asking this question. The key issue here is that these act differently. So we talked about counter cyclicality of bonds. One's going up while one's going down. But large company stocks are impacted by different things than small company stocks. Tesla is impacted by what's going on with things in China, for example. And if they can't get a door handle from China, they can't sell you a car. And Avis may not be impacted by the rental industry, may not be impacted by what's going on worldwide. So different companies, depending on how big they are impacted by different things. And it's even more obvious when we talk about international companies and
so we shouldn't consider or look at this as good stocks or bad stocks when we talk about caps. We're looking at a larger company can probably maybe fight through a recession better than a small company stock.
Great, that's a great example. Yeah, large companies they've made it, they've done well, but they probably aren't going to double their sales tomorrow. Be very difficult for Apple to sell twice as much tomorrow, but a small company, and I always say a mom and pop yogurt shop, might open another branch and double their sales tomorrow. So they're impacted by different things, but there's one is typically large companies are slower growing and have different, you're not worried about them going out of business next Thursday. Smaller companies might be faster growing, but you have the risk of them getting, having really big financial difficulties and struggling.
So a person needs to know their asset allocation, and we're going to talk about that a little bit more, but they need to know what percentage of their portfolio is in large cap, what percentage of their portfolio is in a small cap, what percentage of their portfolio is in international, because you want to, I think the word is called diversification. Is that the key?
The key thing, diversification, is owning things that aren't directly impacted. If you own two electric car companies, if you own Coke and Pepsi, they're impacted by the same exact things. They're not diversified. If you own an electric, if you own a company in South Korea and you own a company, and I would use indexes for all of these things, but if you own the different areas there, they can be impacted differently. And stocks in China could go down while stocks in the United States are going up, for example.
So diversification, you have to be diversified if you want safety.
Correct. Yeah, this idea that, don't put all your eggs in one basket is definitely applies to the stock market. And part of you don't even want all eggs in your basket. You want an entire, buffet in your basket so that you don't have the same issues.
And that's why it's important to understand the terminology, because if you don't understand the terminology, then you can't be diversified.
You can. And if you don't understand the terminology, number one. So people go out and they just say, I'm going to buy 5 companies that I really like. Well, guess what companies you really like right now? All technology firms. They're all fun to own, right? I would rather own Google and Apple and Amazon and Facebook, but they're all virtually the same, impacted by virtually the same items, even though they're different companies, where there's no real diversification there. When one goes down, they're probably all going to go down very similarly.
Do you have one of the, I can't remember if you have one of the charts showing the different asset classes and how they have done historically?
Never show up without that chart for a Pete meeting. That's your favorite chart, and one of my favorites as well. So we'll get to that one for sure.
Okay, let's go to the next slide.
Yeah. So and I'll mention just there, you invest not only in the U.S. but outside of the U.S., and that adds extra diversification there. Then there's also what are called equity styles. And there's 2 different main styles of investing. And one is what's called the growth style, where you're investing in companies that are in favor, we love them, and hopes that they're going to continue or will grow faster than the stock market. You definitely can look at this list: Apple, Microsoft, Amazon, Tesla, Google. People love these companies. People think they're going to grow forever. And those are definitely growth stocks. Value stocks are typically the old economy, slower growing, out of favor companies, but you might be getting a good price if you buy them. So companies like JP Morgan, Berkshire Hathaway, which is Warren Buffett's company, Johnson & Johnson, ExxonMobil, you can see the difference between the two, but they might be at attractive pricing and you can do well. The way I would think about it,
somebody own both types?
yeah, so a balance of growth and value. It's very just like diversifying across the different types that we talked about before, but also diversifying against the different styles, because when growth stocks tend to do poorly when interest rates are going up. So value stocks tend to do poorly when economies are falling apart. So you want to own a diversified and understand, have a sense of whether you're only investing in growth or only investing in value. Value is outperforming growth by a lot this year. When the markets are going down, those value stocks are doing better than the growth stocks.
Let's go to the next slide.
The benefits of equities, long-term growth. This is the growth engine of a portfolio. It's going to be very volatile, but over time, you're expecting to earn higher returns. They've averaged that 6 to 7 above inflation and historically averaged 9 to 10%. One of the areas everyone's thinking about today is inflation. Equities actually over the long term tend to be very good inflation protection. If there's inflation, companies like Apple or Tesla can raise prices to meet inflation and stay ahead of inflation. Bonds get beat up when there's inflation in the world. So it's important to understand that over the long term, over the short term, stocks aren't a super great inflation hedge, but over the long term, they're a very good inflation hedge. And then stocks can be tax efficient, where you can buy a stock, hold it for 5 years, sell it then, and not pay any taxes necessarily along the way, unless they're paying you something like dividends or something along the way.
And then there's dividends are the 15% max on the qualified dividends for corporations. That still exists, I believe.
Yeah, zero. It's either taxed at 0%, depending on how much you have, how much you make in a year, 0, 15, or up to 20%. Taxed the same as long-term capital gains.
And remember, long-term capital gains taxes, a married couple can have close to $70,000 plus of capital gain income and pay 0 tax.
Yeah, long-term capital gains. If you're the people that are buying and selling, they're giving away way more to the government of their gains than someone that holds it for more than a year or is getting qualified dividends.
Yeah, and that's why index funds are probably the way to go, especially in the equity area. Just make sure that whatever indexes that you purchase, that you stay diversified.
Exactly. And they're naturally diversified. There are no index funds with 3. I mean, I guess there's some that might be very specific to an index that is like a tech index, but broad-based indexes and like the US the S&P 500, which is the biggest index, 500 largest US companies, that is you're already very well diversified, much better than anything you could build yourself.
Vanguard has an all stock market index.
Absolutely.
That's about 3,500, I believe, companies in the United States. And it has small cap in it, large cap, I mean, if you want to keep it simple, you can really keep it simple.
I think if you want to keep it simple, you could buy 3 index funds, call it a day, and look at it once a year and rebalance. I like all-in-one funds that do this for you. You really can keep it simple. So making it look easy, making it look easy, you definitely could do that yourself.
Yeah. And the more complex you make it, the less control you have, and the more money whoever your advisor is or broker will make.
Yeah, I call that milking their clients. So making it look complex is milking their clients. And I think that there's a level of complexity that doesn't need to be in portfolios, and simplification is
the market is going to do what it's going to do. And there is not one individual out there that can control it.
That's very true. Very true. Including our elected officials. We like to think that they can take care of it. Comparing comparing these over the long term. And I really want to point out a couple things here. So this chart is a famous chart going back to 1926. Even though it ends at 2018, the numbers are actually very close. And this is showing us the long-term average return of inflation. Inflation is averaged 3% over the long term. Treasury bills, those are basically cash, has earned just slightly above that, 3.3% over time. Government bonds, the bond market, about 5.5% over time. Large company stocks, large cap stocks, 10% over time. And small company stocks historically have done much better. And the reason, the two other points I want to make with this chart are not only the returns that you're seeing here, but the benefits of compounding. So you can see that the difference between investing and earning 10%. Now this is a 90-year time frame, and I don't have a 90-year time frame ahead of me. But you can see the difference between the final result. If you invested $1, that dollar is now worth $32,000. So this compounding issue does make a difference over long periods of time. But the most important thing is look at the difference in how steady these lines are, right? So when we look at cash, the line's not jumping up and down. When we look at bonds, we add some bumpiness to the equation here. These are the 70s when we saw interest rates get spiking here. But then when you invest in the stock market, large companies, you see these big declines. And think, this is depression, the depression here. We've got world wars, we've got COVID, we've got all kinds of things. We've got the 2008 financial wreck here. Yet over long periods of time, if you can, I call it the Rip Van Winkle approach to investing, fall asleep under a tree over any 5 or 8 year period, you're pretty happy with what you ended up with.
If you were to do a chart with corporate bonds, where would that fall in?
Very much just slightly above the government bond number here. So just barely in this range here.
Yeah, but it would be in the same range. So
yeah, you're looking at maybe 6% over time. So again, right in this range right here.
So if I were to now invest using this chart, shouldn't I put all my 100% of my monies in the small stocks?
No. So
why not? It tells me that's my best rate of return. It's kind of like if my mother bought a CD, she's not going to buy a lower CD amount.
Yeah, let me point out so this number here, this is a minus 80%. You lost 80% of your money. So the investing in these different areas could totally eat away your wealth. It's risk and reward. Again, the steadiness is our risk. There's no bumpiness to cash, very little bumpiness to bonds, much bumpier, way, way more bumpy. And if you need your money in less than 10 years, you may not have it all at the end of the 10-year period in especially small stocks, but maybe even large stocks. So there are periods of time where bonds were a better investment than stocks. So
as you get older, you have less time, and therefore your portfolio ought to change.
Correct. And making up for those losses gets to be very difficult.
Don.
Mark, a minute ago, you had made a passing reference to the fact that you could hold like three index funds and you'd be perfectly happy and do the Rip Van Winkle approach. What kind of 3 funds would you talk about?
Yeah, so I would own a total US stock market index. So that's investing in, as Pete pointed out, 4,500 of the US companies. And that will include the next Google, the next Apple. We just don't know what they are today. And it'll include a bunch of losers as well. But the good ones will bubble up to the top. The bad ones will bubble down and we'll own smaller. I'd own an international and probably a non-US stock market fund. And then I would own a bond fund, one that's maybe a total market bond fund as well, if I wanted to keep it very simple. And so you could buy 3 tickers, be done, and move on from there. The key part to all this, to Pete's point, is what's the mix of those that you own? Is it 50%?
And that depends on them.
How do you put the puzzle together is the key.
Yes.
And that's the driver of your returns, is putting it together, not so much the individual pieces. And that's driven by how, your risk tolerance, your need for risk, and then your capacity to take risk older people can't ride out a 50% stock market decline, so they shouldn't be 100% in the stock market.
Right.
Yeah.
Thank you.
Yeah, good question. So let's jump to the next slide. Things that I think that people need to know about the fixed income world. And the key number one figure is when interest rates go up, bond prices go down. And when bond prices go down, when interest rates go, when interest rates, I forget which one I said, but when rates rise, bond prices fall. When rates fall, bond prices rise. And we can see that it's been in a 40 some year decline in interest rates. So this chart here is a chart of government bond 10-year bond interest rates. And I'm sure a lot of people remember that when they were paying 16% a year. That's, I hear these stories all the time about people who are like, I remember my mortgage was 11, 12, 13%. My money market was paying me 10, 11% on my money just sitting there safely. Well, what's happened is rates have gone down over this period of time, and that's made bond prices go up. But we're in a category now where this isn't going to continue going down off the screen forever. We're probably not going to negative interest rates. So we could very well see, and we are seeing rates go back up again. I certainly don't see them getting back to the 16, 14, and 12% levels. Who knows? But getting back to that normalized level, that Pete pointed out, back to the 5-6% range would not be unheard of over a multiple year process, not next Thursday. But understanding this dynamic is super important. And why is this important? It's important because we are in a place where rates can go up, and that will make your bond prices go down. Why does this happen is sometimes confusing. And I always use an example of if you owned a 20-year certificate of deposit, 20-year CD that's paying you 2% today, and next year, all 20-year CDs are now paying you 4%, you aren't very happy that you're earning 2% for the next 28 years. So for you to be able to sell that to someone, no one wants it, you'd have to lower the price. So rates went up, so your bond price went down. And the same would be true if you owned a bond paying you 6% and rates go down to 4%, everyone wants your bond. So they're going to have to pay more for that bond. So that's that dynamic there, that opposite dynamic.
So for today, for practicality purposes, in your client's portfolio, what is the duration, or how many years out are you going out on the bond funds?
Yeah, so the key issue, so some terminology here, there's maturity and duration of bonds. That's basically how long you own them for. So if you own a 30-year bond, effectively that's a 30-year maturity. And
but that's a long-term bond.
That's a long-term bond. Today, I think that you're crazy locking in 30-year interest rates at 2% or 3%. A year ago, 10 years, you were locking it in at 2%. And I think people are going to be very disappointed. They'll earn their 2% over time. You know what you're going to earn. But if you could wait a year and buy it at 3%, then that's a better thing. So I think certainly not being long-term is my number one recommendation. But nobody can guess the interest rate markets from here. Who knows? We were wrong. A lot of people were wrong for saying, oh, it's now 4%. It can't get lower, and it went to 3. Can't get any lower. Went to 2, and who knows where the next direction will be. But the next 3% move is going to be up, not down. Is at least my opinion.
So you're recommending, or your client's portfolio, you're recommending short-term bond funds and then a small portion in mid.
Yeah, so I call them core bonds, things that are very much like the bond market, but then supplementing that with things that can do well when when interest rates are going up. Short-term bonds are a perfect example of that.
Okay.
Now, just like everything else, timing this, well, I'll just get out and come back when the water's safe is a disaster. So in the bond market, trying to predict interest rates is just as hard as predicting stock market rates. But I think being long-term, the risk doesn't justify the extra benefits. So that's why I'd stay away from long-term bonds.
Yeah. I think it was called the long-term growth company. I can't remember, but there was a bond company that was started by 4 Nobel Prize winners, PhDs. They had created a computer algorithm saying that they could predict interest rates. And they were one of the first companies to be bailed out by the government.
It's called long-term capital management. And
yes, that's the company.
Nobel Prize winner on staff. And they
nobody can predict long-term interest rates.
And it was the black swans, the issues, we all, COVID's the perfect example of those black swans that you can't predict. Putin invaded Ukraine was not something that people were predicting. So those black swans will get you. And when you have leverage and other things, even the smartest people aren't able to tell. Their crystal ball isn't working any better than my crystal ball.
Because we're talking about the future. When we invest our money, we're not talking about today. We're hoping that in the future, the rate of return will be normal or bigger, or give us a rate of return without losing the money. As you said in the slide, there is not one investment that is risk-free.
Not a single one. Yeah, different. And there's risks of losing money. There's risks of not keeping up with inflation. There's all kinds of different types of risks as well. So even cash has risks involved with it.
Yeah. Let's go to the next slide.
The other part is, and we're seeing this today, is the fact that bonds can go down in value. People had forgotten because of that. The interest rates have gone down for 40 some years. So people thought, oh, I can't lose money in bonds. Not the case. When rates go up, bonds go down. And so here, this is a 2-year treasury. 2YUST is the 2-year treasury bond. If interest rates go up by 1%, you're going to lose about almost 2% in your bond price. The longer the maturity, the more you'll lose. That 30-year bond holder, when rates go up by 1%, they're going to lose 18% in their bond. And people investing in just the general bond market, when rates go up by 1%, they're going to lose 6% of their principal. So understand this dynamic is really important. People had forgotten it and they're reminded of it. This is a chart here actually showing the actual return of what's going on here. And we can see here 2-year treasuries started 2021 at 0.73. This is the yield on that. And they've spiked greatly, up 1.5%. And people that own those have lost 2.5% of their principal, or a total return of 2.5%. And we can see that here where 30-year treasuries haven't gone up in interest as much, only 0.5%, but they've still lost 11% of their value. And since 2021, we've seen rates go up a lot. People are losing like 25% of their value in 30-year treasuries. And then the total bond market, we've seen almost a 1.25% increase in rates, and people are losing about 6% here. So the safe part of the portfolio, when rates are spiking like they are really starting to see the pain here with owning bonds.
Are people still, I'm talking about us 70-year-old or 70 and older group, do we tend to focus too much on the fixed income area?
I think that I see it all over the part. I think a lot of people put it in fixed income and then just forget about it and don't manage it and don't worry about it. And it was a matter that, again, well, the last 10 years, I didn't get bit by owning a long-term bond. So what can happen? Well, we're starting to see that. So I think it's just, I've been pounding the table saying the most important asset class that people are making the biggest mistake is in fixed income, because they have too much maturity risk or duration risk. And when rates eventually go back up again, and again, no one rings a bell saying now rates are going up today, the impact is greater than what most people think.
How about going to your slide of and give us a definition of what does it mean, alternatives?
Yeah, so this particular slide is saying people are like, well, I'm going to earn 2% in the bond market. That's not enough to pay my bills. What do I do? And so specifically brokers want to sell you stuff. And so they were saying, oh, just buy these other types of things. Buy a dividend paying stock, buy a high yield or junk bond, buy master limited partnerships, which are energy related holdings, buy real estate investment trusts or REITs, or buy commodities. They were saying, buy these other things and they'll do better than the 2% that you're going to get. Well, this is a 2008 return. Stock market was down 35%. Bond market was up 5%. That counter cyclicality that happened then. Yet look at what happened to the rest. You were taking enormous risk. It's not comforting when you take money out of the safe part of your portfolio and it loses 48% or 30% or 20%. So the alternatives to bonds that people are using people are asking for trouble there. And it's not, you really have to be careful about that side. So as much to Pete's point earlier, bonds are a very valuable part of the portfolio. If you want to take risk off the table, invest in shorter term bonds. That's the most common way to protect, not invest in other types of things. In terms of alternative investments, I don't really have any slides here, but those will be things that are in this category, but they might also be emerging market equities, or they might be junk bonds, or they might be floating rate bonds, or other types of things that people might put in that category.
And what makes this area, I think, so difficult is that it's constantly changing.
Yes.
It's not static. And so
that's why I love it so much, but it's frustrating, and it makes us look a little hypocritical at times, because I might have said to a client call me and saying, hey, should I buy this? And I said, that's ridiculous. And then 3 years later, I say, oh, we should be buying this. And they said, is this the same Mark Wilson who called me 3 years ago and gave me a hard time? Yeah. Well, world has changed. Now's a time to be looking at these things. So there's never a never in investments. Maybe there's some nevers in my mind, but in terms of, there are opportunities here, and each of them will have their day in the sun, which is why you want to diversify if we hammer that home.
Yeah. Let's go to the next slide. We've got, let's see, Don, the voice of God. How much time do we have left here? And Don is
about 20 minutes.
About 20 minutes. Okay, thanks.
I think we're doing good.
We're doing well.
Yeah. So stock prices, what to know about stocks is it's volatile. You're going to lose. We mentioned, why wouldn't I stick it all in small company stocks over long periods of time? I think you're going to do better there. But over short periods of time, it's really hard to own these things. This chart is a chart showing the large company stock returns of each calendar year. So in 1980, the S&P 500, the 500 largest US stocks, made 26%. Fist pump, woohoo. But sometime during that year, your investments dropped 17%. So even though you ended the year, if you closed you took a nap from January to December, you earned 26%. If you watched it every day, you saw a day where your $100,000 is now 17% less. And if you look at this, all of the calendar year numbers look pretty darn good. The numbers are we see the tech wreck here. We see the global financial crisis here. Who knows where we're going to end up with this year with the negatives. But over time, you see big numbers here, but you also see large negatives here. And we've been a little bit spoiled with these -3s, -7s, and -5s, where the stock market did not look volatile at all. I didn't worry too much, but over time, the average drop in a year is 14%. So if you're going to sell out every time the market drops 10%, you're almost guaranteed you're going to sell out of the stock market and not get these kinds of returns at the end of the day. The other part I think is a really fun part interesting part is we talk about averages. And my son always tells me, be careful of averages. If you put your feet in a bucket of water and your head in an oven, your average temperature might be fine, but it's not exactly the safe thing to do. And so the average return of the stock market's 10%. But if I look across here, how many 10s do I see? I see one. I see an 11, and I see a 12. Stock markets are average, does not mean you're going to get 9, 10 every year. It's actually a wide range. So understand that, because jumping in and out, getting scared out of the stock market, you should never be investing in the markets at all.
So you as a financial advisor, a lot of times are preventing individuals from doing stupid stuff.
If you ask me what's the most valuable, well, so Vanguard did a study called Advisors Alpha, which means advisors adding value. And they said the ability, and they have 6 different criteria: keeping costs low, putting things in the right spot, asset location, all these different things. Little help, little help, little help, little help. Keeping people from doing dumb things, behavioral things, that was by far the biggest impact. 1 to 3% average added return by holding hands. And as I always say, my job, the most important job, is to put you in the right portfolio so I can hold your hand through so that you're not running towards the flame. So you're not running towards the flame, right? That looks great, we should put more in it. And you're not running from a tiger that really isn't. The bush rustled and you run away from it. Those are the 2 most important things that an advisor needs to be able to do for their clients.
So I will add to that, incidentally, since I've been responding to them, so we don't keep coming back into them along here. In a sense, maybe I'm holding people's hands because the number one question that people have so far through this is, my portfolio is down 10% for the year. Should I get out now? And my first thought is 10% is not bad, because the market's down a lot more than 10%. So that's actually pretty good, but it's stay the course. If you feel there's a disaster, that's your business decision.
I think, Don, when somebody asks that question, it's a great opportunity to look at their portfolio to see whether or not it's properly diversified.
And the other part of that is go see your financial advisor and talk to them and see about where your portfolio is and what you're doing, and understand that they'll change over time. And you may be approaching 72. I mean, I'm past 72. But looking at it, it does differ. But if the only difference is the market went down 10%, that stinks.
Yeah.
But over time,
but the other thing too is when somebody says their market, it's one of the most difficult things to find out for my clients anyway, under trust, is to see what kind of return they receive. Most brokerage statements don't give you that. They just tell you, okay, this month we're down 10%. They don't tell you what your total return is, or distinguish a withdrawal or an addition. It's pretty static. How much money do you spend, Mark, on your software, figuring out a client's quarterly returns?
Yeah, so software across all the software that I use for clients for all the different tools, I'm north of $25,000 a year on software. So it's very common, but the one helping clients see what their portfolios are doing, and helping that they can log in every day, see what they own, how it's invested, that asset mix. We'll talk about that and show that a little bit more, and the performance. So they can say, and so at the end of the day, when the clients see, oh my gosh, I see the stock market dropped 900 points yesterday, and they call me and I say, your account's down 3% this year, whatever the number might be, they go, oh, why am I calling? And they hang up at the end of the day. Or in most cases, the most important thing is the expectations. So if hopefully we have the conversation saying, Mrs. Smith, this portfolio will have days where it's down 10, and we're going to talk about that way ahead of time, so that when those times happen, it's miserable and scary, but at least this is within the norm of what we can expect.
Yeah. Richard Thaler, I think from Chicago University, wrote the book called Nudge. Yep. And he was saying that he doesn't even open up his statements that he gets from the university through his pension plan. because once he looks at the statement, then he's tempted to make a change. So he tries to do it only on an annual basis. And this is the guy who wrote the book. So can you imagine what we're feeling? All of a sudden there's a 900-point loss in the market. And we go, oh my God, as an animal, our instinct is to either run away, do something about it, because we're in trouble.
Fight, flight, or freeze. Those are the three things we do whenever there's something scary. And all three of those are terrible things to do when investing.
With your money.
But reevaluating, wow, you never told me this go down 10%. I understand it now. Does that mean we should make a change as a result? Or my life is different. I'm retired, or I'm going to give some money. I'm going to buy a new home. I'm going to move to Ohio. Those are times where it might make sense to look at your asset mix and make a change, because the markets went down and it's within range. It's not the time to be reactive, to fight, flight, or freeze. Is not the time to do those things.
Let's talk a little bit more about asset allocation, Mark.
Yeah. And so and I can jump to those slides, Pete.
No, go through this, but I want to.
Don't follow your gut. This is very much what we're talking about here. This is a consumer confidence chart showing that they have a ranking here. When people are confident, this is marking how is the stock market do from these inflection points here. And the main thing isn't the number specifically, but you can look at when people are confident, future returns are not that amazing on the low end. And when people are miserable and definitely think the world's falling apart, look at the returns that happen a year later, 22, 19, 29, 32, 14. So when people are at maximum pessimism, and we never know what that number is, are we at maximum pessimism now, or can it get worse from here? It can always get worse from here. When people are scared, returns are typically better. When people are confident, typically worse. So the two lines, my favorite lines are by the time the smoke is cleared, the train has left the building. That's one of my favorite lines. And then the classic Warren Buffett line, be greedy when others are fearful and be fearful when others are greedy. And this is a perfect example showing those times.
But if you're in a sales world, which is the financial services world, because the annuity sales, the mutual fund sales, the partnership sales, these things are the best opportunity for them to sell stuff, because
100%.
people buy things on emotions.
100%. It's like thank you for calling. Let me go sell you something else and make a transaction and make some fees. So
annuity sales are up over all-time highs,
sadly,
because people are quote unquote selling securities, security, not securities.
Correct. Exactly. Yeah. And
so don't follow your gut.
Often at the worst times and often at the highest commissions.
Let's go to the next slide.
Yeah.
I love that slide, by the way. Thank you.
Oh, good. I know you say that about all of them. The issue here is about what is the impact of this getting scared out of the markets and getting in at the exciting times. This is the average investor return from 2001 to 2020. We have a tech wreck in here. We have the global financial crisis in here. And the average investor return is a whopping 2.9%. If they took and invested in virtually anything other than what they did and just shut their eyes for the whole time, if they invested in any of these, they did better. And so how do you put together a bunch of things that earned 3.7 to 10%? How do you put that together and earn 2.9%? Fees and jumping in and out and moving your money around. That's the only way you can do it. And just a good old 60-40 portfolio, 60% in stocks, 40% in bonds over that period of time earned you double the return. And that over a 20-year period is a big dollar number here. So for someone that can buy and hold and rebalance wisely, they can do way better than the average investor over time. This is what's called the behavior gap, right? So just simply this is caused by behavior, not caused by the actual investments out there in the world.
And people like to think is that, do I have quote unquote the best? mutual fund? Do I have the best financial advisor? You don't need the best. You know, there is no guru out there. Nobody has a crystal ball. And so it's a matter of cost. It's a matter of asset allocation and being diversified and sticking the course. Do not listen to your gut.
100%. I totally agree.
Let's go to the next slide.
Yeah, and I will share my other favorite quote here. Jane Bryant Quinn, the Market Timing Hall of Fame is an empty room. And so understand that no one is doing this well. No one knows anyone who's doing it well. I'll hit this home. The US market has been on a tear, has been the best performing stock market for a long period of time. That is not always the case. So I would encourage people to look and diversify into some international companies outside of the US. This is a chart showing which one is leading for some period of time. And the IFA is the international markets, of course, the US. So the international markets led for 2.5 years by 80%. Then the US markets led for 3.5 years. Then the international markets led. What we've seen more recently, and you see this back and forth and back and forth and back and forth. The average time period one leads is about 5 years. We're at 14.5 years where the US is led. Does that mean the world has changed permanently? I don't think so. I think there's a good chance that, again, whether it's next Thursday or 3 years from now, that international stocks will outperform. Have a piece of your portfolio in international stocks.
Yeah, it's hard to be excited in the financial world if you just kept it in a diversified portfolio. I mean, CNBC would go
broke.
Yeah, would go broke because it'd be pretty boring.
Yeah, no, all you need is a 2-minute, the TV show should be a 2-minute show once every month saying, yeah, you're doing fine. Throw away all the, some people call it financial pornography. It's almost that bad where they're trying to scare you into watching more. And I would say this about financial news as much as maybe even the news in general as well.
Yeah. Let's go to, we got 10 minutes, I believe.
Yeah. So the other area, and this is to the point that you were making earlier, is should I be picking stocks? Should I be picking stocks? Or should I be picking people who pick stocks? This chart here is a chart, long-term chart of professional stock pickers, professional equity managers, how many were underperformed basic index funds. And if we look at these numbers here over a 10-year period, 86% of professional stock pickers underperformed basic index funds. Over 20 years, 90% underperformed.
So stop thinking about the best. The best index fund is the market.
Yes, so so people think index funds are the average. Why would I want average, right?
Yeah.
Think that when I'm going to bet on, if I'm going to bet on a 100-yard dash race, I know Usain Bolt is going to win that race against everyone else. So why wouldn't can I just find the Usain Bolt of investing? It just doesn't work that way. Yeah. As much as we want it to, it doesn't work that way.
There is no Rolls Royce in the investment world. They want you to think there is, but there isn't. All your major Harvard, Yale, PERS, all your pension funds are starting to now go through index funds.
Absolutely.
Because they're seeing that the highly paid professionals are not beating the index funds on a regular basis.
And over long term, that compounding gets bigger and bigger and bigger. So costs matter. And if they're not adding value, it's very difficult. Does this mean they're all idiots? Does this mean they're just all bad, evil people? No, it's because they're so brilliant. That's the key thing. How am I going to find a stock that does better than the markets that hasn't already moved up in price? If everyone knows that Apple's a great company, the price goes up accordingly. There are no if I think about an Easter egg hunt and you had a bunch of professionals for 10 years looking for Easter eggs, you're not going to find an Easter egg. It's just not going to be there. So why, and when these highly paid, experienced people trying to pick the best stock, the market's very efficient. Now, there's going to be wacky times, but finding a stock that Easter egg that no one else found is very, very, it's just hard to believe. So if professionals are underperforming, who am I to think that I'm the next great stock picker? And then two last points. One is Warren Buffett, the poster child for the best stock picker ever. The last 10 years, 15-year time frame, he's underperformed the S&P 500. The great stock picker hasn't done as well as index funds. So this year he's doing better, but we'll see what that looks like. But it's been very difficult.
Mark, let's move forward a couple slides.
Absolutely.
I think we're almost there.
I know I want to go forward 2 slides.
Yeah. And if I hit the wrong button, I get this. I need to go back here. Yeah.
Because we have a bunch of questions I want to talk about.
Perfect.
So.
Perfect.
Sorry
I think you're at the end there, Mark.
Yeah, we're definitely there.
Mark, I think we've done the stock market. We've done the stock market. Let's go to forward 2. One more.
Pete's favorite chart here.
Yeah.
So this is Pete's favorite chart. It's an asset class quilt chart. This is putting it all together. How do we put it all together? How do we think about things? This chart here is showing the returns from each year of the different asset classes. You can see in 2007, emerging markets equity, we're up almost 40%, commodities up almost 16%. International, this is a developed market, equities almost up 11%. You can see the difference and see that REITs that year were down 15%. And then the next year, what the returns are next year and so forth. The key things here is if you look at this chart, you can see a very clear trend. And the clear trend is there's no trend here. There is no reading the tea leaves and telling you what the next year is going to bring. And so what do people do is they look at whatever's performing the best and they buy more of that. And whatever's doing the worst, they sell that stuff. And they're chasing returns. And that's part of why that investor return, that behavior return difference is 3%. You lose half your money chasing returns, selling the losers and buying the winners. The important thing about this chart is this asset allocation line. Well, guess what? When you put them all together, and this isn't an equal mix of them, but a mix of, and in the bottom, it shows you the specific mix, 25% in one, 10% in another, and so forth. When you put it all together, you end up with something that's not at the top. You'll never be at the top. You're never going to be at the bottom. And if you look at the returns overall, they're not so bad. We're pretty happy with them. And so from 2007 till today, that mixed portfolios earn almost 6%. We had a minus 50% decline during that time period. And year to date, we're not seeing such good news, but you can see the mix there. It wasn't the best, it wasn't the worst. The second column is volatility or bumpiness. You've reduced your risk substantially. You're almost at fixed income or bond type, or you're slightly higher than bond type volatility. So you're getting a steady return by putting them all together. And that's because everything acts a little differently and has their time in the sun.
Mark, next page.
And then the most important part of all of this is know your pie chart, know your asset mix. This is the biggest, keeping it at the highest level, but understanding what is your stock bond mix. Is it 20% in stocks or 80% in bonds, or is it 80% in stocks and 20% in bonds? And what does that imply? It implies a number of years that you're going to see pain. Also, how big can that pain be in those years? So I'd focus on those. It'll also imply returns going forward. This is, again, 90-year numbers here. Don't use these historical averages and think that these are past as prologue here. A 20% stock, 80% bond portfolio is not going to earn you 7.2% over the next 20 years. And
we're Mark, just so you know, we're going to be speaking more about this next week on asset allocation.
Yeah, Laura's going to cover that. It's perfect. Yeah. It's the most important thing, understanding what you own and then understanding how you put it together, and then how you can fine tune that to make the most sense there.
Stop sharing.
Stop sharing. I am there.
Thank you. And again, one of the important things that we've run through a couple of these slides at the end quickly. First of all, next week, Laura will go into more of these things in detail in terms of setting up portfolios and selecting. Also, the material that we just went through is the handout material that's on the website. So if you're going, wait a minute, I missed that chart, or I want to go back and look at it, go ahead. There's been a lot of comments made, and I understand the frustration. You know, in past years when we've done something like this, the market's up, everything's great. Oh my God, I love all this stuff. And now that the market's not doing as well this year, there's a lot of, oh my God, I have to get rid of everything I have and cash it out and go to Poughkeepsie or something. I don't know what. There are times when I lost a lot of money in the past, you know, in this crash or that crash, and I feel the pain because we did exactly the same thing a long time ago. Have a plan, meet with your financial advisor. It's the questions come up a lot of times of, well, who's the best kind of advisor, and how do I decide what's best, and how do I do these things? And I'm going to say a lot of it is interviewing them, talking to them, talk to others, and get a feel for what's going on. It doesn't mean they're good just because you like them, because that may not be the right answer. Yes, Pete.
Yeah, look, we said it. First of all, make sure that the advisor is fee only. Make sure that you understand that the advisor be a fiduciary. Understand the fees. And, you know, then go by personality. Personality is important. You don't want to change every other year. But NAPFA is an excellent resource. Mark, are you a member of NAPFA?
Of course, yeah, long-term member.
And what does it stand for?
National Association of Personal Financial Advisors. So it doesn't have the word fee only, but it requires, so 600,000 people call themselves financial advisors. Only in the range of, I forget what it is, like 5,000 are NAPFA members. So I've gone to the point of submitting a financial plan, and our fiduciaries, fee-only fiduciaries, you're automatically, there are others that aren't NAPFA members that are solid advisors, but there are, you're moving down you're narrowing down that funnel of people by going with a place like NAPFA.
If Mark wanted to be, one other point, if Mark wanted to make, if his only goal was making money, then he'd be a broker. Okay, fee only fiduciary advisors make good money, but not anywhere close to what brokers make. So
I have bags under my eyes because I couldn't sleep.
Just so people don't understand this industry whatsoever. What's some of the other questions?
Couple questions. One, do index funds pay a dividend?
Yeah,
often they do, yes. So it depends on the index, but most often they pay some dividend.
Okay.
If you do the S&P 500, there'll be companies in there that pay dividends.
And those are
so from a bond standpoint, is a 5-year bond term a reasonable term today?
Yes.
Okay. Thank you very much, Mark. And Mark's contact information is on his Ask First forum that is on the website. And, you know, have questions for him, have questions for Pete and I, let us know as we go along. This is financial and estate literacy. This is It's Your Money, week 4, equity and fixed income investing. We thank you very much for being here. And next week, we're going to pull all these pieces together, as we keep saying. It's not that we're shoving everything to the end. It's, you know, now we've talked about it. Let's put all the pieces together again. And that's what we're going to do next week. So Pete, I thank you. Mark, I thank you.
Thank you.
Always a pleasure.
Yeah, Don, thank you.
It's been fun.
Yeah, you've been another great host.
We've done it again. Thank you very much.